Welcome to the daily update, where I'll go over the action in the market for Thursday, January 16th, and we'll see how things look for Friday, January 17th. Had a little bit of a down day, but we're seeing things internally showing continued improvement. We had the solid update on Wednesday in reaction to CPI. On Thursday, we chopped around, didn't really show any conviction. Mega caps and large caps didn't do all that well, but when we look at the S&P, things are shifting over and still looking a little bit better. Now, the big thing, the hurdle that the S&P has to get over is the 50 period simple moving average. And until it does that, we're really going to have a hard time remaining positive. We have to get that level back. And that's the line in the sand between positive and negative in the intermediate term. Now, we're positive in the short term because we're back above the 20 period moving averages. They've actually fallen down enough to fall a little bit lower than the 50 period moving averages. We're still positive in the long term. And we had some major inflation information come out this week with the economic reports. That seems to be friendly to the market. We had a lot of reports that were released on Thursday, and a few things that could be a little bit influential on Friday. So let's go back and talk about what happened. We had a higher open. The futures were fairly positive. Europe was having a really good day. Germany, I believe, hit an all-time high with their index, but we couldn't really get going. We hit resistance right at the 50 period simple moving average, which right around the 59.62 level. That changes a little bit every day because it's a moving average, so it recalculates. And then we fell below the unchanged level. We found support at the daily pivot at 59.39. And that's kind of what evolved as the day went on. We were range bound between the daily pivot to the downside and the 50 period simple moving average to the upside. And then by the time we closed, we were at the daily pivot. We were down 0.21% on below average volume. Now, another thing that's going to be happening on Friday is it's the monthly options expiration. And that can be influential because you have a lot of strike prices that the market's going to be jockeying for. This can also, quite often, produce a lot of volume. Sometimes on options expirations, we don't see that, but typically there'll be a real uptick that way. And we are still positive in the short and long term. We're negative in the intermediate term. Interest rates continue to come down. The dollar was virtually unchanged on the day. And this is helping stocks, even though they didn't really do all that well on Thursday. If interest rates can keep coming down, that will help. And then we have the geopolitical things going on with the inauguration coming up. There's still the fires in the Los Angeles area, and then all the different things going on around the world, which don't seem to have that much of an impact right now directly. There was a ceasefire between Israel, Hamas, and Hezbollah. Apparently, that's now fallen apart. We'll have to see if that can be put back together again. All right, so some comments. It was a mixed day with the mega caps underperforming. And then Fed Governor Waller, who's a voter with the FOMC, said that he believes that there could possibly be 3 to 4 rate cuts this year. The market could have just taken off and skyrocketed based on that. But the Fed has come out and said we're going to pause rates. So, and this is not Chairperson Powell. So when they say something, yeah, the market pays attention to that, but it has to come from the chairperson themselves to really make a difference. The S&P is hitting resistance at its 50-day simple moving average. I already discussed that. And we're still finding support for the NASDAQ and NASDAQ 100 at their 50-day moving averages. We fell below that. We got them back on Wednesday. Now we're still maintaining that support level after Thursday. The smart money indicators that we follow, they're still positive for now, but they're pulling back. They didn't have a really good day in Thursday's session. We still have a confirmed Hindenburg-Ullman, which at least for a few more days is kind of sitting in the background, but I'm not showing that chart right now unless something changes. And we're looking pretty good with the McClellan oscillator. We've actually got to an extreme positive reading. We're seeing internal momentum picking up, and I'll show you that throughout some of the charts here. And no change to the scenario that the Fed's pausing their rate cuts for right now. There had been some fear that they may actually need to come in and raise rates at some point. Well, the PPI and CPI that came out this week helped at least settle that down a little bit because the Fed has also increased their inflation outlook. The dollar was virtually unchanged. Interest rates were down. We're at 4.61% from with the 10-year yield, where we had been at 4.65%. So this is a little more market friendly. We were getting quite up into the high fours now. I dropped following the 30-year. I look at it every day, but if we start getting back up to that 5% level, we almost got there. We've been coming down with the 30-year. If that comes back into play, I'll continue to talk about that again. And sentiment is still negative. We ticked down a notch. We had been at 29. Now we came in at 28. And we're now showing a weakening trend. So the ADX has dropped below its moving average. We are still negative, though. The red line is above the green line. With this slight down day, I kept our bias at mixed right now because we really didn't show an awful lot of conviction one way or the other. And our momentum is mixed to positive, and that's the last 2, 3, 4, 5 days kind of taken together. Okay, the economic reports that came out. This was kind of a long list. I don't have charts for all of these. We'll just go through the major ones here and then the ones that we typically follow. Retail sales came in up 0.4%, less than the 0.5% they had expected, and down from the 0.8% that we saw last time. So seeing a little bit of trailing off there, but it's still going up. When you take out autos, we were also less than expected at 0.4%. They expected it to be up 0.5%, and this is up from the 0.2% that we saw last time. Another report that's really carrying a lot of weight these days are the weekly initial claims. They came in at 217,000. That's more than the 212,000 that they had expected and up from the 203,000. So a little bit of an uptick there, not showing an awful lot of strength, at least lately. But the continuing claims also continue to go up. They're at 1.859 million, where they had been at 1.877 million. And I do have charts of all of these to show you. The Philadelphia Fed Index came in at 44.3. They expected it to come in at -6, so that was quite a bit better, where last time it was at a -10.9. And these are the ones that I don't have charts. Export prices came in stronger than last time. Export prices, when you take out ag, also came in higher than before. Import prices, the same as the last reading. When you take out oil, also the same as the previous reading. Business inventories came in as expected, up 0.1%, where last time they were unchanged. The NAHB Housing Market Index came in at 47, a couple of ticks up from 45 that they had expected, and up one tick from 46 that we saw last time. All right, so here are the core retail sales year over year, kind of trailing off just a little bit, but we're still above zero. Month over month, also declining from what we saw previously. The Philadelphia Fed Index really bumped up here. And I don't know, the Eagles are in the playoffs. Maybe that's helping. Who knows? So people are doing a little bit more manufacturing these days. And business inventories also picked up a little bit from the previous reading that we saw there. The NAHB Housing Market Index continues to go up here, and it's been more or less climbing if we go back to last summer. The continuing claims did decline, and we're continuing to go down a little bit here with the moving average, where the initial claims picked up, but we're still going down with the 4-week moving average here. And taking this all together, where we saw a decline with the continuing claims, an uptick with the initial claims, and then we plot the unemployment rate on here to give it more context. Looking at Isabel Net with Real Investment Advice, says rising interest rates lead to valuation reversals. We're possibly seeing them coming back down now, but rates have really been going up. And this can have a real impact on the valuation of stocks. And when that gets under pressure, that also puts the market under pressure. So, I mean, going up with rates and coming down with the S&P, at least when this was prepared. And they're using the CAPE valuations. That's Robert Shiller's more smooth approach that I go over in the intermarket analysis video on the weekend. It says third-year returns in bull markets can be weak. And we know, that whoever's president at any given time, if things go good, they take credit. If things don't go really well, they're blamed, and people feel justified in taking whatever stance they want to take. But we've had two good years, 2023, 2024. A new administration is coming in. There are going to be some changes, and there might end up putting some pressure on the market, at least for 2025. Then equity market concentration today is particularly high relative to history. A lot of folks are in the market right now, and just means that they like the stock market. Are we getting a little extreme here? Do people think, though, well, if I just put my money into the stock market, it's automatically going to increase in value? That's when we typically run into some problems, as you can see here from the past. And then the equity earnings per share growth expectations over the next 12 months based on global data and TS Lombard here. And then if you're looking at a couple of years where we have the equal weight, that's in green, and then the dark blue are the mid caps and the light blue are the small caps. Now, this is going to be really hard for the small caps if interest rates continue to go up because they have to borrow so much, and that bites into their earnings per share. But if interest rates can come down, the light blue areas here, at least a lot of folks are expecting that. It really hasn't happened. Small caps have had a pretty good week this week, but they should have broken out by now, according to how a lot of people are feeling. They should have broken out back in December. And then the ISM prices paid when we look at services versus the year-over-year CPI, and then they shift it all around here. And you see a pretty strong correlation between the two, where the prices paid is going up. And so are we going to see the CPI with the lag here also go back up, which means inflation could be starting to increase again. The dollar rose again in the fourth quarter and will be a modest headwind to earnings. Yeah, this can pressure stocks because of the exchange rate. It seems like there are less dollars on the books if the dollar is stronger. Also, the import-export relationships back and forth tend to favor a weaker dollar rather than a stronger dollar. Equity positioning across the sectors. And you see the mega caps and tech, that's where most of the money goes, where we see a lot of money coming out of materials, healthcare, real estate, and energy. But this is the real growth area of the market, and it's real where the market cap is really focused as well. And looking at another chart, it's similar to what we looked at in yesterday's video. Where is the money going into bonds as of late? And a lot of it is going back into bank loans here, where we had been spreading it out across different kinds of bonds, depending on what's attractive at any given time. Then the global money market fund assets coming in at 9.7 trillion right now. Just more informational here. This was kind of interesting. Wall Street expects the perfect year for corporate America. See, that's the thing. You can look at charts and they talk about how everything's going to go really bad. Other charts like this one talk about how things are going to be really good. That's why I do a day in and day out analysis of what's happening. And then based on the information that we're given, we reach a consensus of, okay, things are looking better, things are looking worse. And I don't do forecasts myself, where it says profits in every sector are forecast to grow in 2025. Okay, well, if we have a real downturn in the market, this chart is going to somehow be rewritten and talk about how it's falling apart instead of coming together. All right, here's our intraday chart. We're a really slow day, not an awful lot of conviction. We did have a higher open, but we're bumping into the 50-period simple moving average. You don't see that here because this is an intraday chart. That's based on a daily chart that I'll show you, but we just could not get above that level. We came down to the daily pivot and then just chopped sideways. It looked like we were getting ready to break a little bit lower, but that didn't last very long. When we got a little bit below the daily pivot, came back up and then closed just a little bit under the daily pivot. Here's our intraday chart, and we're up slightly in the initial overnight session as I got ready to record this video. And we're still looking okay here with the blue line above the red line, even though it came down later in the day. The blue line is growth on an intraday basis. The red line is value on an intraday basis. And we like it better when the blue line is above the red line. This is still holding up fairly well. If you go back to the end of November, we're seeing S&P growth of value on an intraday basis really outperforming here. And as the market's been going through some difficult times, at least this has been pretty much going sideways. End of day growth was down where value was up for the large caps. It was up more for the mid caps and even with the small caps. So we're seeing a little bit of a tick up here with small cap growth to value. And we're trying to break out a little bit above this recent range that we've been in with the small caps, but can we actually see more follow through? They were up a little bit in Thursday's session, but not really showing the strength that we had been seeing before, especially after the CPI report came out. Mid caps ticked down just a little bit, but still looking pretty solid. They're bumping into their 50-day moving average as well right now and can't seem to get above that. The S&P growth to value ratio still looking pretty solid here, which quite often will lead through into positive price action. And then we're seeing a little bit more of a deterioration when we compare growth to value with these two ETFs. We're coming a little bit further back down into excuse me, into the rainbow. But discretionary to staples ticked down a little bit, but still looking pretty solid there. And that's another growth area of the market. Large cap growth did decline, but is still at its 50-day moving average. So this support level is holding. The trend is starting to weaken now because we're dropping below the moving average with the ADX. But we're still negative because the red line is on top and the green line's on bottom. However, we are trending because we go above the static level of 20 here, this blue line. So it's a negative weakening trend. Short term, seeing pretty much that same thing, even though the red line's coming down just a little bit. We're also dropping below the moving average here. So it's a weakening trend, which sometimes can happen before we get set for a reversal. Even with Wednesday's really big up day here, it didn't really change our trend indicators all that much. And we dropped to below average with volume, but it had been picking up lately. Sentiment, we're still getting a high reading with the Ulcer Index. This is one way of measuring fear or greed. When we're above the moving average, that just means fear is increasing. We ticked up a little bit here with the VIX, both with the line chart and the bar chart. And we ticked up a little bit with the VIX of the VIX, both with the bar chart and the line chart. The momentum for the VIX, because of that big upward thrust that we saw and then came down pretty quick, the MACD is picking that up, and we're actually turning to a downward momentum, which could be positive for stocks. The skew index is still giving us a high reading here up in this red area. It has been now going back about a month or so. We'll have to see if anything changes because Friday is options expiration, and this is calculated using options. We'll see if this adjusts after Friday, since a lot of those options are going to go away if they've been dealing with the front month with options. And a real tick down here with the individual investors and their weekly survey actually dropping a little bit more negative. And this is another way of just looking at that same thing. You have the white is bullish, which is going down, the red is bearish, which is going up, and then the spread between the two, which this chart right in here where I'm circling, that's the reading that we show on the chart that I post here. And then they use an 8-week moving average here where I track things more with a 50-day or 50-week exponential moving average. All right, so we just ticked down, or actually ticked up just a little bit here with this fear gauge, but really no change. And we also ticked down a little bit here with this other fear gauge. So we're seeing a little bit of a contradiction there as far as our sentiment gauges. Went back up with the equity put call ratio, and we're going back up with the 5-day. Here's a longer term chart. And we're also, okay, this was not updated. This should be going back up right now. I looked at the chart, but it's not updated here, so I apologize for that. Also showing that fear is decreasing with the volatility risk premium down below the band and going down. This could actually be more positive currently for stocks. The advanced decline line still improving, still above their longer term moving averages, and even with the down day, we did advance based on price. We were pretty much flat based on volume. Also seeing an improvement here, more new highs than new lows, so we're seeing more green than red. We're starting to go back up with our 5-day, and our 10-day is trying to go up, but is kind of still flat here This is improving too. The advanced decline ratio, both the blue line and the red line, are going back above zero. So these are subtle little changes that we're seeing inside the S&P that are improving here. We did tick down a little bit with accumulation distribution, but we're still above the moving average. So this is still positive. And we came down with the histogram with the check and money flow, but the red line is continuing to go up. So this is still treated as positive. We came down, but we haven't quite dropped below the moving average with the chicken oscillator. So this is showing some weakness, but is still positive. So our three smart money indicators remain positive. We ticked up with the red line, down with the green line, and we're still negative with the vortex. And a little bit of an improvement here with the cumulative advanced decline line based on price for the S&P. It actually ticked up, even though the S&P closed down. A little bit more of an improvement here based on volume as well. We're seeing a bit of an improvement with the 10-day average of the highs and lows for the S&P after it had really been going down. It's starting to show some improvement there. And we're above zero and continuing to advance here when we measure the advancers minus the decliners. So this is actually turning positive. We're still seeing an improvement with the NYSE advanced decline line in relation to the S&P, and we're going up with the NYSE cumulative advanced decline line above the moving average, seeing a bit of an improvement here, but still below the moving average with this regular NYSE advanced decline line as well as this other regular NYSE advanced decline line. Seeing a little bit more of an improvement with the NYSE when we look just at the common stock based on price and volume. So these are subtle little possible improvements that we're seeing coming into the market. We're seeing an improvement with the advanced decline line studies, going back up with the common stock on the NYSE, coming back up close to the moving average with the S&P, crossing a little bit above the moving average with the mid caps, but they're hitting resistance at the 50-day moving average, and an improvement, but still below the moving average with the small caps. And we're improving here with our broad market measure of the highs and lows and then taking a 5-period moving average of that. It is coming up, it's still negative. This is showing some pretty good short-term momentum. We crossed above 50 with those stocks in the S&P above their 20-period moving averages, and we want to get above 70. That will show good, solid momentum as measured by the next chart here. And this is looking somewhat positive right now. Well, we came down, we dropped below this 10 level, started to go back up, came back down, set a higher low, went up, came back down, set another higher low, and now we're seeing pretty good breadth or pretty good thrust from this. It'll be even more positive if we can break above 70 because what we're looking at happened last spring where we had a low reading and then we got up above the 70 level and then you can see how not straight up but how the S&P performed after that. We're seeing if something like that is developing here in the short term. We're seeing an improvement with our 50-period moving average study here. And even though we are dealing with a negative trend that's measured based on 50 periods, this is showing the stocks inside of the S&P above their 50-day moving averages are improving, but we're still below 50. We're also improving with those stocks above their 100-day moving average and 200-day moving average. So these are some more internal things that are looking a little bit better. And we're still having a really difficult time getting above the 50-day moving average, and we were below average with volume here. And I've been watching this chart pattern here. Now, I don't draw the wedges and the flags, and I just don't really find much valid in that kind of stuff. But what I do see here is when we set a high and then we came down, the Fed freaked out the market and then we bounced up from that, but we made a lower high. We came down, we barely made a lower low intraday here, came back up, set another lower high, came down, set a lower low, and now we're coming back up. And we haven't even come back up to this red line yet. So this is still a vulnerable looking chart pattern that we see, a series of lower highs and lower lows. If we can break out of this, that's really going to improve things. We are still seeing an improvement with the 20, 50, and 200 period moving averages on the S&P. Tick down, but still above the midpoint with the Stochk RSI. Also above the midpoint with the Williams percent R. Above the midpoint with the CCI 14 and 20. These are our short-term indicators. And ticking down, but still looking better with our short-term stochastic. Intermediate term is still looking good, and we're starting to turn back up with our longer term stochastic. Now, again, these are just a further subdivision of the short term time frame. and we're dropping down, but still positive with the force index, showing some improvement here with the short-term trend. We're above the green line and the blue line, and those are starting to turn back up. If we can stay above that, that will help things quite a bit. And we're above the simple and exponential moving averages here. We haven't broken that. We're coming back down close to the simple moving average based on 20 periods. Well, if we run into some pressure in Friday session, we'll be watching that level to see if that holds. And we're coming down, but right about at the midpoint with our standard deviations chart and going down with the balance of power. This is actually picking up things of being a little more negative. We're still negative, but improving with the go, no go with the lighter purple. And we're above the midpoint with our highest high, lowest low value chart. And the TTM squeeze is still improving. We have the lighter shade of red and it's going back up. Going down here with the ease of movement, it picked up some weakness and we're still below zero. So this continues to be negative. The Arun's coming off of that extreme negative reading and is no longer extreme since it's starting to go back up, but it's still negative. And with the McClellan oscillator for the S&P, we're actually showing some good internal strength here, enough to get us above the 60 level. So now we're considering this to be extreme positive, but that could also suggest good momentum, especially when the longer term trend remains positive. We're going back up with the summation index based on price and volume. That's positive. And we're above zero and going up with the NYSE McClellan oscillator. So we're going back up with the summation index based on price and volume here. So these are subtle internal improvements that we're seeing. We're still seeing the Swenlin trading oscillator, both confirming each other. They had been going in opposite directions. We're going up based on price and volume here. So that's turning more positive. We're trying to improve as far as momentum when we look at the PMO, but we're looking better when we break it out based on price and volume. Both of these have crossed above their moving averages. And internally, because we look at PMOs for all the stocks in the S&P, the PMOs that are rising in the S&P is going up, the buy signals are going up, and we're starting to go back up with the PMOs that are above zero. And the short-term momentum, turning back a little bit more positive above this red line. It would be even more positive if we could get back above zero. The MACD is improving, but hasn't crossed above its moving average yet. This is more short to a little bit intermediate term. So we're seeing an improvement in the short term with the slope. We're turning back up with the TSI, but hasn't gone above its moving average yet. These are two short-term oscillators. We're seeing an improvement with our intermediate term oscillators, but they haven't crossed above their moving averages. We're still going down with the tricks, and we're trying to turn up. It's still below the moving average with our longer term KST oscillator. And we're starting to barely come above the moving average here with the Copic curve. So that's showing an improvement. We tick down a little bit with the Sean trend meter. And when we're in this yellow area, it's more neutral, but we take the context. Are we going up or are we going down? So not really giving us much there. Ticking up, but still below 50 with the money flow. Ticking down, but still above 50 with the ultimate oscillator. Ticking down a little bit, but still above the moving average with on-balance volume. We're right a little bit above 50 with the RSI 14 as well as the RSI 9. And the Pring bottom fisher is still giving us a buy signal that actually generated before we started to go up. Now, sometimes this can be a really good signal. Other times, it's not a very good signal at all. And we're watching the mass index right now. 2 out of the 3 criteria have now been met. We went above the red dash line and the blue line. That's 1 and 2. Now, when it crosses back down to the red dash line again, that's suggesting that a reversal could happen. But we're just waiting to see how that will play out. We're still positive with the Elder's Impulse system for the S&P, but we're still negative with the parabolic SAR since the dots are on top. We're still below the blue line and the red line with the 50-period moving average condition here, but we're staying above the red line. And we're still having a hard time getting above the red line here is the simple moving average based on 50 periods, where we did clear the exponential moving average based on 50 periods. So we're coming down here. You can see the spaghetti mess here with the 20s coming down and the 50s going sideways here. The 100 did hold up. This ended up providing support on a closing basis, and we've been coming up since then. We're just more concerned about these series of lower highs here, and if we can break out above that. So the market has some things to deal with, getting above its 50-day moving average and then breaking out of this more dangerous looking pattern here. We are improving with the bullish percent index. This has turned to positive since it's above the moving average and going up. It would be even more positive if it can go above 50. Going back up with the NYSE BPI and the NASDAQ 100 BPI. Running into some overhead resistance here with the 20 period simple moving average of the open, high, low, close. The high is the green line, and we're just having a difficult time. Now, this is short term. So we're seeing this showing overhead resistance in the short term. We're also seeing that lining up with the 50 period moving average, simple moving average as well. Still up into the high end of the cloud. We have not broken out of it yet, though, but the blue line is below the red line. That's slightly negative, and we tick down a little bit with the green line. Still, this is longer term, going back to 2009. We came up to the upper end of this trend channel, and we've been having trouble getting back up above that again. And we're still looking more positive here with the Heikin-Ashi chart, but we're negative and pointing up though with the Kagi chart. We're still negative with the Renko chart, and we're negative with the three-line break chart. So not a shift there. Long term, we're continuing to see an improvement with the 150 and 200 period moving averages. So the long-term trend is showing a little bit of resurgence here. We're still positive with all the different stock indexes that we look at, but we've switched to short-term negative with the NASDAQ 100. And bonds are still negative across the board. They've got a lot of damage to repair to turn back positive that way. We're still positive with commodities in the short and intermediate term. And the three growth areas, discretionary, communication, and tech, they were the down areas in Thursday's session. We need these to really do well and be leaders to really take the market higher. And saw a little bit of red and green or blue, depending on what color you see here, with the NASDAQ crossing below 19.5 and then 19.4. Utilities did pretty well on Thursday. We had a BPI cross above 50. Real estate had a BPI cross back above 30. It's just been getting hammered lately and trying to show some improvement there. Energy had a BPI cross above 50 as well. So these are some of the areas that have really been getting hit. They saw a little bit of an improvement in Thursday's session. And we're still continuing to go up here with the equal weight, but it's still underperforming the weighted version of the S&P. And we're still coming down here with the ratio. So on a daily basis, the equal weight actually outperformed. When this is going up, that means the weighted version is outperforming. And we're having a difficult time with the Dow getting above this pivot point. It just can't seem to do that, and it's still below its 50-day moving average, but it's still positive with the diamonds when looking at the Elder's Impulse system. Right now, we're watching the 50-period moving averages again for the NASDAQ. That's holding as support, and it's also holding as support for the NASDAQ 100. We've gone from positive to neutral with the Qs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 continues to be negative, but trying to improve. And we're dropping back down below the 50-day moving average here with the Qs. That's not really showing up on the indexes, but it is here with the ETF. And small caps were up 0.27%, still trying to get out of this range that they've been in. We have this overhead pivot point here, which may act as resistance. And we're still dealing with the 50-period moving average. And we bounced off the 200-day moving average with the Russell 2000 small caps, but now we're just kind of going back into the range. We are above 50 with the RSI, and we're starting to turn positive with the momentum as measured by the MACD. We continue to be positive with the Elder's Impulse system for the small caps. This is the 50-day moving average for the mid caps. We'll be keeping an eye on that if we go up to see can we get up above it and then close above the 50-day moving average. That would help things there. We're still positive with the Elder's Impulse system for the mid caps. We're still having a hard time with the bank ETF getting above its 50-day moving average again. It declined. It came up to the 50-day and has been coming back down. The financial sector was actually up 0.2% and is above its 50-day moving average. The Wilshire also having a little bit of difficulty getting back above and closing above its 50-day moving average, as is the total U.S. stock ETF. The FANG index is still hanging out above its 50-day moving average. These are the mega caps. Even though they were down, we're still above the blue line here. And we're still hanging out above this longer term support level, even though we declined in Thursday's session with the FANG index. And you're going to see this when we look at the Magnificent Seven and Eight or whatever we look at here. Apple was down over 4%. Amazon was down 1.2%. Microsoft was down 0.41%. Google was down 1.35%. Meta was down 0.94%. Nvidia was down almost 2%. Tesla was down 3.36%. When you get all these stocks doing the same thing at the same time, that's why the index has had a hard time. So you could say that the index has held up better. We're seeing an improvement underneath the S&P 500 without the mega caps really having any kind of a good day. And we were also down with Netflix. So all of these ended up being down in Thursday's session. The semiconductors were up. We're coming up a little bit further above the 50-day moving average, but we want to see, can we break out of these recent highs? Now, it looked like we were breaking out only to be faked out, and we came back down to the 200-day moving average. Let's see if we can get a little bit more strength there. And this is another thing too, longer term, where we hit some highs here and we just can't seem to break above that with the semiconductor ETF, but we're at least coming up out of the rainbow a bit. And the Dow Jones semiconductors, they were actually down 1%, coming back down to their 50-day moving average. The SOX index was up just a little bit underneath its 200-day moving average, but still above its 50-day moving average. So getting a mixed picture here. And going back up because semis held up better than tech in Thursday's session. And kind of topping off here in the short term when we compare US to world stocks, but the longer term correlation continues to get stronger. Oil was down over 1%. We had got up into the high 70s. Now we're in the, well, we're still in the high 70s at 77.85. The dollar pulling back just a little bit. Now it's going to show an uptick here because this trades 24 hours a day. So we're actually bouncing up a little bit after hours. We're continuing to come down with the 10-year yield, and that could be really positive for stocks if that continues. And we're going up with the 10-year based on price. We're seeing an improvement here when we look at home construction to 3 to 7-year bonds. It had really been showing some weakness. Now it's trying to improve. If we continue to go up, is this 250-day moving average going to now act as overhead resistance? It acted as support two other significant times. And we're keeping an eye on Japanese rates because that's what triggered everything last summer. And that's the red line down here. When we crossed above that 1% level, that was freaking out folks in Japan and produced a real panic there that spread throughout the whole world. Not much of a change here, but we're just keeping an eye on this to see if this is the catalyst for some kind of negative thing that could happen again. Seeing a bit of an improvement, trying to come back up to the 200-day moving average with our total bond ETF. And looking at our growth to value ratios, below the moving average with the Qs to S&P, above the moving average with discretionary to S&P, still below the moving average when we compare large cap growth to large cap value. So with the large caps, we're under the moving average. We're on the moving average with the mid caps and the small caps. So what's our outlook for Friday? We are starting to come into earnings season now, and that could take over as different companies report and some really have an impact on how the market behaves. We are showing improvement, but we're still below the 50-day simple moving average. And it will be options expiration in Friday's session. Okay, this didn't get updated here. We'll have to look at the next calendar. All right. So we're going to have housing starts and building permits on Friday, as well as industrial production and capacity utilization. And we're pretty much done with all the major things, according to this calendar, that really can impact the market. Seasonality for January 17th, we're negative with the Dow and S&P and neutral to negative with the NASDAQ. So you combine that with options expiration, we'll have to see how it goes. Now, looking at options expiration week, we're up 47% of the time and we're down 53% of the time. So a little bit more leaning to the negative side for options expiration. Where next week we tend to turn more positive. We're up 62% of the time and down 38% of the time. So here's options expiration, seeing a little bit of a tick down here with the post-election S&P green dash line. And now we're coming into the second half of January, where we tend to perform well, but it's usually in the first half of January when we perform the best. Small caps not really going anywhere, but they should be doing really well based on seasonality, just not happening in reality in 2025. Still in the positive time here, according to Tom Bowley's research for January. So we are still negative with the advanced decline lines, but we're seeing an improvement there. And we're still going up with our 5 and 10 day equity put call charts, even though I didn't update that one chart. The parabolic SAR is still negative. The oscillators are still mostly negative, but they're trying to improve. We're just barely trying to come back above the moving average with the Copic curve. We still have this confirmed Hindenburg Ullman. The vortex is negative. Our moving average studies are negative, but showing an improvement. And if we get above that 70 level with the 20, that could show good short-term upward momentum there. The ease of movement is still negative, the money flow is negative, and the momentum for the NASDAQ 100 is trying to improve, but negative. Our smart money indicators, they are pulling back right now, but they're still positive when taken together. And so we have them lining up with each other now. Growth and value still holding up, but we'd like to see growth doing a little bit better. And discretionary is doing good, even though it pulled back on Thursday. These ratios are holding for right now. And we're already extreme with the NYSE, excuse me, the S&P McClellan oscillator. We're positive now, looking better with the NYSE McClellan oscillator. So that's turning the summation indexes back up. And we're going up and looking more positive with the Swenlin trading oscillator. The bullish percent indexes are turning back and looking more positive. We're still above 50 with the 200-day moving average steady there. The ultimate oscillator is positive, and the financial sector is looking better, even though the bank ETF went down. So our conclusion, we're turning more positive and improving. Now, we could lose this if we have a pretty significant down day, but we are seeing some internal things, not necessarily in price. We saw that on price on Wednesday. We saw improvements, but not on price in Thursday's session. Large caps and growth are still holding up, but they are pulling back right now. We are still positive in the short term because we're above the 20 period moving average. We're still negative in the intermediate term because we're below the 50 period simple moving average, and we continue to be positive in the long term. Thank you. Have a really good day. I hope you found this video helpful, and I will talk to you in the next video.